Eric, thanks for doing this.
Good to be here. Thanks for having me.
It's been a long time coming in some ways. I guess I invested in Ramp Series B, which was probably 18 months ago, and it was about 8 rounds ago, I think, maybe 15. I forget the exact number. There's been a few rounds in between now and then. So thank you for your performance and for the venture industry's excitement in what you guys are doing. I feel, it's been a fun run. It's hard to believe it's been 18 months, but I don't know if you remember this. So I've been spending time in like spend management, your category broadly, but in Delegating from Founders Fund kept telling me how well you guys were doing, and I was like, corporate credit cards, like that's not for me. I'm like a pure software guy. So I sent one, maybe 2 emails, and this was like November 2020. And but then I written it off. I was like, they have Founders Fund, they have Co2, they have D1. These guys have t-shirt cannons full of capital. Like this isn't corporate credit card. Hedge funds involved, not for me. And then out of the blue, you responded like probably 4 weeks later. And I was like, what? That's interesting. I wonder what the prompt was. Do you remember what it was that was like, oh yeah, I should get back to this guy now 4 weeks later?
I really got to figure it out. After this, I'm going to dig in, see if I can put it together. Honestly, I just think it was, I think it was the number of people who had mentioned that you were digging, we really should do it. And I'm happy I did. It's been an amazing relationship, helped us figure out a lot of, what are today our fastest growing products, but I got to go back to where it all started. I don't know.
Well, thank you for that. Yeah, I'm going to clip that up and send it to now in future cold emails I send you saying that. Yeah, normally I have to pay people to say nice things about me, so I guess in some ways I did pay you to do that. But well, this is great. I fortunate to have been a small partner in the journey. It's hard to believe it's only been 18 months now. But so maybe we'll go in a bunch of different directions here. But I think try to talk through some stuff that you maybe haven't talked about in the past. So first, you're from Las Vegas. You grew up in Las Vegas, right?
I did, yeah.
People live there. And so maybe, yeah, exactly. I had no idea. So how did your family end up in Vegas originally? What was the connection? I assume at least 2 generations of people, for the most part, haven't lived in Vegas, right? Your dad's not from Vegas.
No. They were from Southern California originally, and it was one of those things where my parents met in LA. I think that they imagined they'd be there for most of their lives, but my dad was finishing medical school. He was a doctor. He got a call from a friend who was a few years older who had gone out to Las Vegas. It turned out opened a practice, and he said, I'm a little bit, I'm really busy. I could use the help if you come up here.
No way. What year is this?
Probably mid 80s, something like that.
And Vegas, I assume, was like booming from a growth standpoint then?
It was just about to really get revving. I mean, I think at some point in the late 90s, it was the fastest growing city, I think in the US, and I think in even the Western Hemisphere. It was one of these things where I was born in 1990. I think there was about 300,000 people, just about. When I left for college 18 years later, there was almost 2 million people.
Wow.
So it just boomed, and it changed a lot. But yeah, the city kind of sucked him in. He went out there and, stayed for a lot of years. And I guess I had a sort of funky warped childhood.
I was going to say, were you like high school classmates, like kids of pit bosses and like blackjack dealers?
Yeah. Yeah, all of it. I mean, it was like tons of people worked in the casino industry directly, lots of people in construction. I had a neighbor who used to fly every day to Area 51. He never would really tell me what was going on, but like it was funky in all the ways that you would, you would think about it. And I don't know, I guess I realized it was like a strange city. And
Did you know that as a kid, that it was a strange city? Or, I mean, as a kid, you're sort of like, I don't know, this is normal. Like his dad's in the circus.
His dad's in the circus. Like you go to like a gas station and there's like a slot machine ringing. There's like an ad for like, I don't know, nightclubs, Chippendales, whatever it is. That's just like a thing.
Yeah.
Restaurants were open 24/7.
Nightclubs, quote unquote.
Yeah, exactly.
Yeah.
True.
Yeah.
But it just was, I don't know.
Did that, I mean, seeing a city grow that fast, obviously, we'll talk about Ramp in a bit, but like, did that impact your view on like what was possible from like a building growth standpoint? It's time to build type thing.
Doesn't one of those guys live in Las Vegas?
Or somewhere in Nevada. Yeah. I think they maybe both do.
Yeah, it's time to build, I guess.
Yeah, exactly.
What is it? So for sure. Look, I just growing up, it just was like they would just build new parts of town all the time, and I'll put it this way, I never really appreciated it. And I went to school out in Boston, and there, like, these are buildings that were like 300, 400 years old. I later spent a bunch of time in China, and they'd have buildings that were 2,000 years old. My idea of an old building in Las Vegas was like 30 years old, 40 years, was like ancient, like the old city hall. There was nothing quite like it. And it just was a place too where when you have those kind of time horizons, the people who built these things were still alive.
Yeah.
The city was built by other people, and it was very different than kind of the East Coaster sort of friends that they'd meet later, where the view of the world was, this is the world, you live in it, go get like a high paying job and do stuff. Where I think for me, I never appreciated at the time what you did was just build new stuff, build new parts of town, build new businesses. And I think I feel really lucky for that.
Yeah, no, it's super cool. So then you, that school in Boston, it was nice of you to not say Cambridge. So you went to Harvard and you majored in Chinese there?
Econ and Mandarin was a secondary.
Mandarin, got it. And what was that? I mean, that was a popular, it still is a very popular language, but a popular field of study around them. But what was your thought process then?
I mean, it just was so different than anything. Like I growing up, I never was great at languages. My Spanish is like fine.
Really?
It's okay, yeah. But it just was one of these things where I was like, all right, I'm at Harvard. They take 4 people a year from Nevada. Like, maybe I should learn something I could never learn before. And
that's wild because like there's no derivative really elements of like the English language that tie to Chinese. Like Spanish is much closer and easier to learn. And you're like, I'm going to go dive in and do this. Why not?
Yeah. Basically, I mean, there was funny things too. I mean, so I showed up in 2008. The Olympics had just happened. The Vegas casinos, people I was close with, they were opening things out in Macau. It just seemed, everyone at the time was talking about this was like the next giant economy you had to know about. And I thought, okay, like I'm going to do it. I'm going to go learn it. And it was fascinating. For a lot of years, I actually thought I would spend my whole career out there. I ended up living in China for almost 2 years across, I guess, 10, 12 trips. Before never, I think I'd only gone to Canada once. And so it just was kind of a fun time to be out there. Obviously not there today, but it was, I enjoyed it a lot because I think even what Las Vegas was doing, you'd meet people who said they grew up in like a village out in China. You're like, wow, how many people live there? And they're like 3 million. And so you'd find sort of just the scale of things was totally different. I liked it.
I've heard you say that, like, in doing this, I need the story about debating. Yeah. So let's start there. The famous debate story.
So there's a video online on YouTube where it's sort of a pastime, I think, in Asia, where they basically put foreigners on TV and they have them like debate or go on game shows or something. And so they had arranged this debate between like Harvard University and universities in England all around the world. And so there's a debate of me debating love and marriage at the age of, I think, 19 years old. So haircut was worse, didn't know what I was talking about, but it was all in Mandarin, it was all on TV, and it was sort of a fun clip.
Yeah, and whatever, 12, 14 years later, you still, like...
I don't know.
Yeah, exactly, still, yeah.
我告诉你，如果你不爱他的话，还跟他结婚，那就是耍流氓。可是我爱他，他不爱我，那我就吃亏了吗？吃什么亏？吃亏。
Your debate, did you win? How did it actually go?
So in the round that's there, was incredible 1-2. I actually lost in the finals.
I don't know. That wouldn't have impacted my investment decision, but that's. And so I heard you say that, like, being over there, you're like, hey, I'm not that special comparatively to other people that have the skill sets I have. I mean, I think you're special, but in what way? Yeah. In what way did that inform like your career decision and ultimately to leave China?
Well, there was a set of things going on. So one, first, like there's quite literally there's over 1 billion people in China, and people were incredibly kind, incredibly welcoming, and it felt like wow, I'm meeting with the, people running companies at different places. This seems like the place for me. But if you really dug into it, thought about it, there was 1 billion people there who spoke perfect native Mandarin. It was unusual that I spoke Mandarin, but the reality was there was tens of millions of people in China who spoke fantastic, perfect English. And so at some level, I'm looking at if my unique skill is that I can speak Mandarin, and actually it's not that unique. Like, is that really so unique? Am I actually so special? And this was, other than maybe you and my mom and a few other people.
Yeah.
I mean, it's just like not really statistically.
Yeah, and I think a lot of investors do. But yeah.
We'll keep safe. I guess for me, the question was like, all right, I'm about to start my career. Could I actually pick up something that was different? And I guess at the time, my hometown, Vegas, had gone through like a lot of hard times, a financial crisis, all kinds of issues with housing. And I felt that in China, they were growing GDP through investment. It was growing like 20% a year, but the actual economy was growing like 6-8% per year. And that was disconnected. And the question was, okay, well, would there be a debt crisis somewhere in the future? And maybe by that time, I could speak Mandarin, but I could have experience of that. Maybe I should go learn it. And so I ended up starting my career in financial restructuring. I had this like harebrained scheme of like, in a decade, I'll come back and it'll be ready. And it turned out there is more distress, but I'm not there. I definitely don't have the right skills for it, but it ended up pulling me back to the States. Yeah.
So you were doing corporate restructuring, which I assume is as sexy as it sounds.
It's now in vogue too.
Yeah, I guess, give us a few months and it's going to be really, really sexy. So take me to that path to starting Paribus, your first company.
Yeah. So I was working in Midtown. I think it was like it was an amazing day if one day per month you could like leave the office when it was still sunny.
Yep.
So just was working a lot of hours, but I stumbled into, I guess it was two things. One, I had like more than, a few dollars of disposable income. I thought back to my first job was at an Express. They sold t-shirts and jeans off the strip. And I remember it was this constant sales culture, where on Saturday it'd be 20% off, on Tuesday it'd be 40% off. You had, some people who'd come in on Tuesday say, I want the difference. Others who you made money because people didn't know. I always thought that was weird. But then later, once I had a little bit more to spend, it started happening. You'd buy a TV, and if you're a Spartan, apartment, and the price would change. And there was kind of one moment when a group of us went on a trip, booked it the next day. A girl wanted to join. We saw that the price was like $100 or different. It was over $1,000 across all of it. And I just was sitting there. I was like, this is really frustrating. And so I found that the airline would refund the difference if you asked. I had taken a little bit of computer science in college, and it was a slow day at work, thankfully. And I just sat there and I was like, gosh, I wish there was software that told me this. Like, there should be some way to track it, and then maybe you could just tell me, or maybe could it contact the store? Could it do this automatically? And just kept pulling at that thread. And I went over that night to my friend Kareem's house. Kareem became the co-founder of Paribus and co-founder now of Ramp as well. We just thought, what if there was software that would help you get that discount difference in price automatically? And so a little bit wandering, but it came from just experiences, my first job, to things that I just had enough time in the day to notice and do something about.
And so how did it work? I mean, you guys got to, were you on Good Morning America, or you were on something, Today Show or one of those, right? So take me through, I mean, it was a very fast, you went through the full startup cycle in like 24 months or something, right?
It was slow to fast. Yeah. So first, that happened, that moment when I went over to Kareem's, we were talking about it. It was probably back in 2013 that we're kind of onto it. And so for like the better part of a year, we just, we're trying to figure out, like, is this real?
And you quit your job to do this?
After almost a year, we did.
So 12 months mucking around, and then...
Yeah, basically. And we were lucky. I think Amazon went from changing like a few 100,000 prices per day to tens of millions per day over that time period. And so some of it was luck, but we'd figured out, okay, you could build like a small email app that's where receipts lived. You could figure out. And so the premise of Paribus was, it was a Gmail, Yahoo, whatever app, where you link your email, we track the receipts, the prices of which you bought. And if you were eligible for a discount, software would write a note to the retailer would refund you the difference, and we charged a cut. And so we basically tinkered for a year until it was real. Like, prices were changing all the time. You could make it that easy. You could just write it with software and do it with no human intervention. The market was large. And so after a year, we left our jobs, we worked on the side, and then we launched the product in May of 2015. It just took off. Within a year, we had almost 1 million customers. We were on Good Morning America, the Today Show, CNN, all kinds of different outlets, some multiple times. We complicated history. We got a pretty life-changing offer from Capital One Essentially, I think it was like a year after launching publicly.
And how many people were on the team at this point?
15 maybe.
Yeah.
And I think we sold
raised a couple $1 million.
$2 million, you know,
and went through YC, right?
Yeah.
Yeah.
Went through YC, things took off. And it was a tough decision because we were basically evaluating, do we close like a large Series A round of funding from a firm we really, at the time excited about, could grow and scale this thing all the way through, or do we sell? And at first we were like, no, we can't do that. We're going to go and take this all the way. But at some point, first, some of our merchants liked us, others hated us. There was real risk.
I can imagine if you're sending thousands of emails a day to Amazon.com, you're probably not like getting on Jeff Bezos's Christmas card or holiday card.
Yeah, it was growing like 40% a month, and so it was getting like exponentially nutty. Meanwhile, like Kareem was on a visa. It was a life-changing amount I'd never seen anything close to like it, to the effect personally, and so we decided to go for it. And so we sold the company in October 2016, and it was very fast. And we ended up spending the next almost 3 years there.
So from quitting your job, doing restructuring to sale, that was how long?
2 years, just under.
Okay, got it. Well, and you stayed at Capital One for how long?
Actually longer than Paribus was independent for. So we left in February of 2019.
Wow. Interesting. And so then you left February 2019, and take me to Ramp.
Yeah. So that in-between period was where it all came together. So our job at Capital One was save people money. And so we spent a lot of times turning data into savings. It sort of was the predecessor to a lot of the activity now, which is bundled under Capital One Shopping. But could we build software that helped people either spend less upfront after the purchase? And we felt like we were just scratching the surface of what we could do.
And was this all through, was Paribus actually integrated within Capital One's, or did they sort of take the lessons you learned and throw it out and be like, hey, go work on this stuff?
So we were really lucky. They'd gone through enough acquisitions that were like a bit funky, put things in like cost centers versus parts of the group with the P&L, that they actually put us in the credit card division. And they gave us a full year before really any integration in a deep way to say, go scale this, get your bearings, spend time with it, and think about how these things can come together, and going down back and forth to McLean once a month to figure out how this would come. But a lot of it was actually this weird email savings group operating with the support of a large P&L. The second year was bringing it together, and then at the beginning of the third, we acquired this company called Wikibuy, which became the backbone of Capital One Shopping. A year later, PayPal bought Honey. There's a whole suite of services around helping people save before, during, and after they shop. But a lot of it was around savings. And then we were right in the heart of the card business. And the thing that was wild was, one, we got to see like, why is Capital One so profitable? What makes the credit card business great? And it is an amazing business. And people were thinking about things that you would expect, like how do you grow purchase volume? How do you grow revenue? How do you reduce or increase net interest margin, reduce the cost of rewards? And in my job, I would just call up customers and I ask them, do you want points, cash back, something different? And it was really misaligned. A lot of customers were actually looking for more in their bank account, not more points. What was many customers, if you could actually just help them spend less, it would help them first get more of what they were looking for. And could you actually stop competing on price, stop competing on the cost of rewards, and instead compete on value? And so we just got obsessed with this idea of what if there was a card and software that could help people spend less. And so I guess what led to Ramp was just too many months of just kind of thinking and obsessing over it, combined with things that were happening in the market that made it possible to actually start a new credit card company in a way that just wasn't possible for 30 years. And so we, after we ended up spending 6 months transitioning the team, making sure it's a good spot, February 2019 left, and in March, so about 3 years and almost 3 months ago, incorporated the company. And it's just, learned a lot of things along the way. We thought the be-all, end-all was saving people money. It turned out saving companies time was much more important than we appreciated too. But we still think we're the first and only credit card company that actually measures ourselves by how much money have we put back into our customer bank account, that actually measures how much time have we saved, which is very different than most people are thinking about what cool lounges can they open up, how can they get you to spend more on the points programs and devalue them in the background. And
Yeah.
I don't know. It's helped us grow quickly.
Yeah. Well, who knows? Maybe you'll get a cafe one day. But so maybe you touched on this earlier, but you were working on a blog post thing about like the underlying infrastructure and the enablement that's allowed FinTech companies to exist today. I think it's a really interesting thread. As you were sort of within Capital One, you were watching some of these play out. Would love to maybe tell me about what you think has happened in the last, 15 years, 12 years, whatever it's been, that's enabled the success of folks like yourself, as well as, other companies in the FinTech space to really succeed.
Well, I mean, first, it just was like so striking to us when we got to Capital One. It just felt like this crazy anomaly where this product that has had a very similar form factor, like the credit card that we use is quite similar to the card maybe parents might use 30 years back, super profitable and has an innovation. Is like, how could that be? How could that market exist with no new entrants for a long period of time? And as we started digging into it, a lot of it had to do with, first, if you were going to issue a financial product in the US and move cards, move credit cards, you needed to be an FDIC insured bank. And the cost of starting one of these banks, buying one of these banks was incredibly hard from a regulatory and time perspective, and cost prohibitive was one. And so I think one of the first things that changed actually came out of the financial crisis. A lot came out of the Durbin Act, in part to help prevent banks which had been consolidating, buying up small banks, and stop the too big to fail problem. Dick Durbin and the regulation basically propped up small banks and said, there's an unregulated and regulated interchange. And if you were a small bank, your interchange could be on debit, could be unregulated, and you could make more. And it gave small banks like Sutton Bank, Celtic Bank, Web Bank, other banks you might see on the back of these FinTech cards, the incentive and market opportunity where if they could find people that could bring volume and they could partner, they could actually go and capture and have a business. So suddenly you had small banks willing and interested in looking for folks that could bring business. As that was coming up, infrastructure players started making that possible, if not doing it directly. So on the merchant side, you had Stripe. On the issuing side, you had folks like Marqeta and then later Stripe, who built these platforms originally for neobanks debit products, but the infrastructure to issue and manage cards were there. Next, so you this paradigm of banks could work with you. You had infrastructure you could tap into, and through an API, you could actually go and issue it. The cost of capital went to almost zero. And so if you wanted to, interchange is great. If you can make, 2.5% on a transaction, that's awesome, but it means you need to put $100 out to make $250. If interest rates are low, the cost of borrowing is low. And so even a startup could tap into that. And last, I think you could tap into underwriting data too. The proliferation of things like Plaid, Finicity, things like that meant you could underwrite not someone's credit history, but that this company raised $10 million. It's probably fine to give them $500,000 in credit for 30 days. And so all these things lock together in sequence. And so we were just looking at this, which is like you've got this space that's very lucrative that has had almost no product innovation. Suddenly the pieces fell that if you worked with the right partner, you could issue cards out. And by the way, you could do this. I think we had our first card transaction within 50 days of incorporation. And so you could not only go after a clear product, but lock the pieces in place from a market perspective to go and build ramp. And that's what allowed us, I think, by when we launched February of 2020, to be supporting large businesses, some spending millions of dollars per month, and rocket so quickly. I think it just was a market that was waiting and needed this different way of building.
Yeah, it's fascinating. I mean, everyone bitches and moans about like regulatory capture and government bureaucracy and all that, but like, preventing things like the global financial crisis from occurring again, ideally. And two, I mean, this sort of had some unintended benefits as well around, I don't think Dick Durbin was thinking through the FinTech element of how this is going to be enablement, but it has, Jamie Dimon bitches about it today about like the interchange rates and what they can do versus what these up and coming banks can do and all that stuff. And so I don't know, it's kind of worked in some ways. And I think it's probably a good thing that some of these banks have been capped in terms of what they can do.
I just think in general, we want to make things that are so good, it's hard for folks to compete. I think competition is good.
Yeah.
I think it forces people who are building things to be better, to push it.
So Ramp, how do you describe what Ramp does today?
Yeah, it's I think it's something, but here's how we think about it. It's so we think about it as a finance automation platform. So we offer the fastest growing corporate card today in the US. We have built-in expense management software, deep accounting integrations, bill payments, and all of these products have been designed with the focus of helping businesses reduce the amount of dollars they're spending on their services and reduce the amount of time that it takes to close their books. And so I think like a shorthand is like, imagine you could get all the capabilities and more of, let's say, an American Express, of, let's say, an Expensify, a Concur, a Bill.com, all wrapped into one. On top of it, you're getting insights regularly that will show you and your employees ways to get better prices on things you're already doing, but also just a better design and little subtle things like on a, let's say something like a Concur or an Expensify. Employees might turn receipts in days to weeks after. I think on one of the platforms, it's 3 to 4 weeks after is the average time between purchase to receipt. On Ramp, because we're processing the credit card transaction, businesses can set rules. We can approve or deny based on your actual expense policy, and we collect the average receipts in 30 minutes. And so it just makes companies work a lot more efficiently. We also connect to 100 different sets of, whether it's HRIS, productivity software, but it's really about making the workflow of where companies are spending money simpler, more efficient, and automated, and trying to take steps away so companies can be more efficient. So maybe a little bit more long-winded, but hopefully gives you the breadth.
It's helpful. I always give the example of like, hey, I think if you were to start from scratch, you would integrate all of these things together, right? And I always say like all your non-payroll spend should be on Ramp. And the example I'll give to people of like how obvious this is I'm at a restaurant, I'm taking Eric out to dinner, right? And we have a rule, if I spend my Ramp card over $100, I need a note attached to it, and I need the receipt as well, right? And so the second that card gets swiped, one, it either gets approved or denied. But thankfully, after talking to my finance department, they now approve my stuff. And then I get an immediate text message, and that text message goes to my phone. I take a picture of the receipt and add dinner with Eric Glyman, and then I press send and it's done. The receipt's in there, and it's just the integration of all this stuff together that I really like, and in using it, I don't know, it's made our finance department's team, our life's a lot better. But yeah, actually using it in the wild, it was counterintuitive to me. I made the joke about like not wanting to invest in a corporate credit card, which is true until I realized that like it was actually kind of a software company, and corporate card was the wedge within this, right?
Exactly it. I mean, the card, we were processing transactions in 50 days. Like, there's complexities around underwriting, but that's not the hard part. The hard part is really trying to figure out, like, in these companies, it's not like, I need another card. They might have like, 3 or 4. They've been pitched on like 100 of these things. It's more of like understanding all the areas of just like pain in that business where people are wasting a lot of time, where people are buying software, they're getting charged too much, and can you surface that data up, automate away a lot of the workflow to make it much easier, and just kind of drive a more efficient and profitable business is really how we're measuring ourselves and what we're trying to deliver to our customers.
Yeah, no, it's great. So we talked about a bunch of the enabling infrastructure that made this moment in time make sense for a fintech company. Whenever I see Ramp in the news or whatever, when people are talking about the industry, much to my chagrin, there's another company that's mentioned in there. So I want you to say something nice about Brex, Eric. No. So what? How do you position? Because that's always the question I get. Is like, okay, how is this different than Brex? And I think now people have started to understand it a little bit more. But how would you, if in an RFP process, right? Let's give you a little bit of a commercial here. But like, what would you say that you specifically focus on? Because they've continued to evolve some of their stuff, and we can say, where inspiration came from. We can debate that, but they've continued to evolve. And how do you position yourself versus your largest venture-backed company that, probably buys AdWords against you?
Yeah. So a couple of things. I mean, first, I think a lot of it comes down to like, you can see the history of what are these companies about and how do they really orient. I think if you go back to even 2020, when what we were doing publicly launched, this orientation. The first moniker was this credit card designed to help you spend less. And I think at the time, it was about, what you would find on the way back machine, 7x points on ride shares, 3x points on this, 2x, which was a product of the time. I mean, WeWork and Uber were still all the rage, and it was very much about access. Whereas Ramp, I think, has singularly and always been really about, we are aligning our incentives with your bottom line. We're trying to help you spend less money, spend less time. And so first, it's philosophical, but beyond it, we backups too. We've helped companies spend $135 million less, automate away a ton of work. But I think the bigger part of it now is there's a much richer set of integrations. We integrate with far more software. The quality of the integrations, like for example, let's say you're a company integrating to NetSuite, which if we're going head to head and there's an RFP, you might see this, maybe it's a later stage company. Not only do we handle two-way syncs, but we'll handle multiple entities in the US, abroad, internationally. You can automatically code at a level where essentially you can achieve 80% of your accounting is actually done through software. And it even replaces things. So for example, one of the subtleties with let's say Brex, would be you still would need, let's say, an Expensify or Concur on top of it. With Ramp, it replaces all the way through and you get a lot of efficiencies. So some of this is more sophistication, some of it's more alignment and capability. But it has to do with really the spend management. What I'd say is they focus a lot on their banking products. They've focused on, I think, some financial planning. I think that they made different choices in trying to go more horizontal for very early stage companies. I think, I think that there's a very powerful set, and I think that I think highly of them. I think it's good to think highly of other folks.
Yeah, I mean that's that was very gracious of you. Thank you. And I think that the cash-based underwriting recognition that they had early on, I think was a great insight, right? And I sort of go back to, I think companies are often, their foundational DNA is sort of established early on and how they operate and the decisions they make and the culture and the people they bring on and all of that stuff. And I was always attracted to your business because you're a software company at the end of the day. And I think at times they've had elements of being a financial service business as well, right? I think at one point they were going to get their banking license. I'm not sure if they did around that. So there's certainly the rewards versus cashback philosophy, but then there's, there's some elements of the product suite you build out. And I'm sure my friends that are invested in Brex will yell at me for saying that, but I do think of it as more of a financial service business rather than you guys are more of a software company, even though you both monetize in a similar way.
I mean, I think they would say that too.
Yeah.
And I think if you look at the history of what's been said publicly to even, independent board members where they're trying to go and pull it to even, decisions, I think that we've made a lot of decisions in our history that are focused on unambiguous and clear and strong, we've higher cashback. Our cashback in our rewards program is more. We've done the math. It is much more valuable for businesses, and we've done it at the expense of margin. There's been areas where I think that they've tried to have deposits on hand for different benefit for go compete. I think trying to be a business neobank at one point was part of their pitch, and I think there's a lot of worlds that make sense. We just have a view of, we think that there is room for a truly great product and engineering driven organization that's really thinking about almost more of the workflows. What are the causes of waste and how can you keep shifting new software day in, day out that chips away, that helps companies be more efficient? And that's a view of the world that we're excited about. And I think that's had influence in the industry. I think if you look at the content of what are people marketing, that's moved, more and more folks are moving to that vision. And we're excited to keep doing what we're doing and competing.
I made a joke one time online that how hard is it to set product direction for 4 different companies? And a bunch of different VCs got very mad at me for that joke because they were all investors and competitors, and the joke was that they were all copying Ramp, and a lot of my friends did not love that joke. So second time doing this as a founder CEO, second time doing it with Gleman as well. Anything you're doing very purposefully and specifically different than what you did with Paribus? I'm sure there's 1,000 things you're doing differently, but like any specific things you've internalized from the past experience that's super helpful?
Totally. I mean, I think when we talked about the start of like this process of leaving, but and starting Paribus, but we had. I think our business plan, we had saved up something like 50 grand and like moved to Williamsburg when it was still like not that expensive and grew mustaches, and like that was our business plan.
This is at Paribus, by the way.
This was at Paribus, right?
You were not moving to the same place in Williamsburg after.
Definitely not. And it was like, all right, every dollar counts. We don't have a lot of time, and we need to produce something or shut it down.
And Kareem was on a visa.
He had 6 months to get sponsorship or some way, or he was out. And so it was all, just as the company was about cutting costs then, it was all about making every dollar really last. So a scarcity mindset was a lot of it. The next time around, we'd had a sale. We were able to start this company with our own funding at the start before we'd even raise externally. And so much more of the mindset on the second time around was not about all the things that could go wrong and preventing it, but more about what could really go right in surprising ways. I think with some of the first, at Paribus, there were some people who just had outsized impact. And so this idea that recruiting and the first 10 people that you hire, and hiring itself as being the be all end all, was a way bigger part of what we did at Ramp. And I think Keith Verboy, one of our board members, has this concept of central casting. This idea of, let's say you're a producer and you're trying to make some new movie, maybe Top Gun, you're like, oh, we got to have Tom Cruise and we'll have this actor and that, and suddenly you do it, and just with the right kind of set of people around the table, you've got a whole movie on your hands and things are right. And the reason that's important is later, I think a lot of startups and company building becomes, how can you hire enough people in the right roles? You're changing all the time. Can you attract people? And one of the first things that people do is they go on your LinkedIn and they see who else is at the company. And if it's like an okay crew, people can get less excited, or if it's extraordinary, people say, what can I do to actually get there? And so one of the first things that we did differently was, out of our first 10 hires, 7 were engineers, 1 was on design, the person was from IDEO, 1 was on talent, and the other was me. I got to sneak in, I guess. But the whole thing, I think on the second time, was much more around really trying to view people and hiring itself as like a strategically central point of the company. I think was the biggest difference. I think the second was, I think a lot of first-time founders are very heads in the clouds. What about 10 years from now? What if Google competes with you? You think about all these sorts of questions. I think in second, you're able to constrain the problems and focus a lot more on speed. We talked a lot about, counting the days at Ramp, and the reason we would do this is we tried to measure ourselves, with every 60 days, were we moving slower, faster, how much faster, and could we increase kind of that speed and ramp of it? And so, no pun intended, I guess, sorry. But
I accidentally do that a lot. I mean, all those points are interesting. It's one of the things about like a willingness to go big. It's nice when you're backing a second time founder who's comfortable and willing to swing for the fences. And I think oftentimes, I don't know, Stuart Butterfield had Flickr and then had Slack or whatever. Like there's a lot of examples like that along the way. But that's one of the reasons I actually don't mind secondary for founders along the way. It's like, hey, I want you to go as big as you possibly can. And so within reason, right? Like, let's figure out what makes sense so that you're comfortable to swing for the fences. But the other thing is like your culture is established so early on, right? And the expectations of how you operate, who you hire, like what is good, what is not, it's really, everything sort of sprawls out from the first, it starts with the founders, but that first 10, like, if there's cancer there, that spreads, right? 100%. Yep. If there's an asshole there, like they're going to hire an asshole, or if they're a B player, they're going to hire a C player. Like all that stuff spreads. And so I've always found it's interesting. And not everyone needs to be like, Kobe Bryant or Michael Jordan on the basketball team. 5 of them would rip each other's heads off, right? But like you need to build the composition of the right talent level so that it all works together. And so I think it's interesting because as you guys went from 10 to 50 to 200 or whatever, like all those, a lot of them came from referrals from that initial group, right? And so I think being purposeful and thoughtful about it has been really interesting to watch.
100%.
Yeah. So maybe talking a little bit more about that and the purposefulness and the speed and all that, your product velocity in terms of how you guys, how quickly you're able to ship product. I've never really seen anything like it. We've talked about this, but I almost feel like most companies struggle with the ability to ship the product, and then like the communication to their customers is the easy part. I feel like you guys ship products so quickly, communicating to the customers is like actually hey, we do all these things now, right? And they're like, didn't you just email me last week? But how have you set up a culture that it enables that level of product velocity, right? Are these discrete teams that are operating autonomously and sort of acting as GMs? Like, how do you hire people that can successfully ship things quickly? And how do you get product into the wild as fast as you do?
Super good. So I think there's two sets of it. So one is like, I think it's a funky product of the history from Paribus to Ramp, which we'll go into. And I think that the other is by focusing a lot on getting process really tight, iterating on that, and then measuring the days and constraining it. The set of problems were the two things. So first, just the history of it. And so I met Will Hockey, who started Column a couple months ago, and I think one of the things we bonded over was like
former founder of Plaid.
And one of the things we bonded over was like for both Plaid and for Paribus, our company, one of the engineering and product problems that we had was many people that we were building integrations into did not want us there. And so it could be as simple as like, we'd have to go and to check the price at a retailer. Maybe the retailer didn't want scraping to be going on.
Jeff was like, fuck off, right? Like, leave us alone right now.
Or the marketing team just like changed the email receipt because like they can do that.
Yeah.
And it meant that you would be building constantly on Quicksand. And a lot of like the upbringing was you're fighting for your life. 2%, 3% of what you would ship would break every single week. And so a lot of it was how do you build things really quickly and in a modular way so you could switch parts out, was just for years and years and years was a lot of it, which turned out, probably made us a little bit of like crazy and bizarre engineers, but it helped us later when we were starting.
I'm sure you guys have a lot of like PTSD from like things going down in the middle of the night or whatever and needing to fix it as well.
I mean, and it's like, it's so lucky. Like, it's like, I'm really happy that Visa isn't just like, nope, never mind.
Yeah,
like this
exactly. Thankfully, you can afford a therapist to sort through all the anxieties that came from that. But yeah, no, I can only imagine.
So a lot of it is that. And then a lot of it too is like, okay, there's this large market. What we'd observed to Capital One was like, it was very hard, mostly for perceived regulatory risk. I think in 99% of cases, it really wasn't real. It just was processes to really cover the other 1%. Things were really slow. And so the question was, how could you, in a space that dealt with real regulatory concerns, as well as we were going to move lots of money, how could we isolate the processes that we take for product development and make sure they're applied correctly? And so there's a part of the Ramp engineering product team that, let's say, deals with credit card transactions where, if that breaks, it's not funny. People's credit cards all break. Like you can't just have it go down 1% of the time. And for that, it's all about like correctness, low latency, extreme level of testing. And that actually ships quite slow. There's another and a very large part of our products where if it's down for a little bit, a front end page, like it can be down for a couple of minutes, bring it back up. And there's lots of things, and you might measure maybe only 2% of people, 0.5% of people might go on. It's a small number at the start, but for those areas, it's all around designing. First, just sprints where the idea is you're going to move very, very quickly. You're going to set at the start, what are you going to get done, move through, retro the things before, and increase sort of the speed that you're moving progressively. And we try to have most of our engineering, and especially the things that we're building in-house and not relying on APIs for, really move super rapidly. And that's what allows us to just spin up not just cards, bill payments, expense management, and really replace full sets of what at other companies are full products or companies with just add-ons. We try to run those in those sets of teams, but separate the duties out would be last. And I think last is just like anything. The more you can set standards around process and then tweak what works progressively, that works.
So obviously you were baptized. I always joke that like B2B is easy mode compared to being a consumer app team. Like people get very, very mad at you. B2B customers are like, I'm going to churn in 3 months. Consumer customers are like, what the fuck are you doing? Like whatever, I'm trying to get on this flight and you messed this up. So no, that all makes sense. And then setting the process and expectations, and some things can go fast, some things don't. What about from a team standpoint? Like how do you actually delegate the responsibilities of these things? I mean, Ramp's a very integrated product, but has modular elements of it, and not everyone's buying 100% of all those things. And so do you have GMs that sort of own and operate autonomously? Is there like teams that are working on this and they're sort of scrum teams and this is the new initiative, and then they go around and they're the entrepreneurial people that you just go point at problems? Is it a hybrid?
I mean, so the first time around with Paribus, engineering sat with Kareem and Gene. Marketing and product sat with me. Design. And I think one of the best things that we did this time was actually flip it. And so with Ramp, Kareem oversees the majority of the headcount by a lot of engineering, of product, of design, and data science. And the way that we think about it is things of structure, things that are being repeated multiple times over are going to sort of multiply out and cascade throughout the product suite. Put these together and have folks essentially work in pods. And I think that the complexity of this has grown over time, but in general, even against it, where at the start it might have been effectively one team, a few different threads, but effectively very, one or a few very small teams, to now multiple teams where it either could be, one person on product, maybe, 6 engineers, maybe one person on design. There's rough ratios, and depending on the certain group that you're in. And effectively, we have backlogs. The nice thing about being in B2B is customers will tell you, if you just ship this, we'll use it. And so you can actually quantify, against all the different needs, have a long backlog and prioritize what takes a small amount of work, unlocks a lot of spend, simple feature that unlocks lots of future things. And we try to build like a car, not a faster horse kind of a thing. Effectively, cascade and run it against it. And so the structure has evolved over time, but I think one of the best things we did this time was keeping the people who were functionally building. And now actually to the earlier question you'd ask of how do we market these things when product moves so quickly? We recently moved product marketing to work with product and to be closer to the sense of build, but things of structure that you need to have, clear view and cascade out, we try to put together.
And so, I mean, I think some element of this as well that we've kind of touched on, of the culture and the product velocity and all that, but you guys are also very accommodating to entrepreneurs within the company, right? And so you have a bunch of founders that work at the business, but also you will encourage people to, hey, treat this as a tour of duty. Let's do 2-3 years together, and then we'll fund you to go start your company if you so choose. Is that... I assume it wasn't that way at Paribus. Some people are very paranoid about talent. Hey, you got to stay here. Golden handcuffs, RSUs, options. We're going to hold, whatever, delayed vestings on all this stuff. But you guys are actually very different in your mindset. Do you think that, one, is that a fair characterization? And two, does that attract a different, I assume it does, a different type of person, and then also a different type of culture internally?
One, I do think it's accurate, and two, I think it's part of, without that philosophy, I don't know that we could do what we do. I mean, I think at one point, I think a third of the headcount, even when you're 50, 70 people, is still quite high, were former founders. It's people who sort of would take, I think the default state of a company is it doesn't work. There is no company. People go work somewhere else. The question is, how can you get enough momentum and a sense of inevitability? You need people who are going to bang their head against the wall and try to make things work. And so I think if you take that as sort of a central premise, and a lot of these people are stubborn and independent and want to go start their companies. And also, I'd be a giant hypocrite if I wasn't supportive of other people starting businesses and entrepreneurs. Then the question is okay, how do we make this work? And there actually is this really interesting pitch within it, which is, at Ramp, we're trying to move extraordinarily quickly. We've taken the time to have talent be an early part of the organization. We're very careful and thoughtful about who we can bring in and have amazing talent engineering. Can you create a place that people want to go to that can feel the sense of talent density? And you could see what it's like. Maybe they'll meet a future co-founder. Maybe they sort of see processes they can bring to their own company. And then later too, if the time is right for someone and it's really ready, to be genuine and supportive. And I think the vast majority of people at Ramp from the early days are still here. There are some which were with us from months to year, a little bit over, who've started now very fast scaling companies. And I think part of I think what I guess they call themselves the PayPal Mafia got kind of right is actually supporting people in an ecosystem over the course of their life is actually just good business. I think it brings out great motivation for people. I think a lot of companies are fundamentally just a system of trust. People who want to work together to build a great company. And if you're sincere in that, hopefully it lasts together for a very, very long time. But if people are already being there too, like I think you can't get real commitment without that, honestly.
Yeah. It's interesting. You touched on the sense of inevitability point, right?
Yeah.
And I think that's an interesting thing that you guys are thoughtful about, of like creating this sentiment that, hey, this is a rocket ship, get on, here's where we're going, and here's where we're going to be tomorrow, because you're counting your days, right? And here's where we're going to be in 3 months, and here's where we're going to be in 6 months. But, in 10 years, like, we're going to be this huge company. Can you talk a little bit about like how you think about creating this sense of inevitability and what the compounding loops are that lead to just this moving from inertia to success?
Yeah. So one, it's like, why do people work at these name brand companies anyway? Like, why do people work in some large consultancy or a large bank? And, when you look at these things at some point, like this was some person's startup company or some amalgamation of different corporates
Totally.
together.
Vegas had 200,000 people, and Capital One was started from scratch. And
yeah. And like, why did Vegas grow? Because it was growing. Like, why do people go to IBM? Because, well, IBM is growing because it feels safe. And I think that if you're trying to endeavor to build something that is going to be for the business plan to work, a large part of the industry, a product that is ubiquitous, the question is like, well, how do you create faith in this new system of the sense of like, this is going to work? And that evolves at different phases. I think early on, it might be, is this large market? Is this a real problem? Is there some unique insight? Is this amazing talent density? Sometimes people say things like the Sandbergism of like, if you get a chance to jump on a rocket ship, don't ask what seat. Like, what makes people say that? And I think even too, like, we're now like a large investment position of Stripe. And I remember it was back in 2017, 18, and we'd ask people like, okay, like if you were going to go to a great FinTech company where engineering is important, where would you go? And like 99 people out of 100 who were in the industry would say Stripe. Like you got to go there. And that density and the excitement around it actually became the core driver for them recruiting extraordinary people, which became the core driver for them building great software, solving business problems, having higher margin, all that. And so the question at the start was like, how do we do that?
Yeah.
How do we do like the Stripe of New York, or like this equivalent in the card space? And so a lot of it came back to first kind of like there was this large market, this different way and unique story to it. Let's build a great team. Let's have a clear model in a sense and actually go and model out what does the business look like over time. And then you really try to bring it together, and you'll see this down to how we hired, to maybe the investors that we decided to and fortunate to work with, to even the set of products and even the pacing and the cadence of it. I think using that as a framework of how do you create the sense of inevitability, this large scale, is actually quite useful, because if you can do that, I actually believe it lowers the cost of attracting extraordinary people, of bringing in customers, all these things. And so a lot of it was around, in order to do that, what are the ingredients that result in that?
Yeah, no, it's, if you can get that flywheel spinning, it's the reason you go to Harvard, right? It's the reason people go work at Stripe. It's like, I would imagine that the education you can get at Harvard, like there's other places, those books exist, right?
Yeah.
But like the association with it, the credibility of having gone there, the people you'll meet, all of that is, worth its weight in Bitcoin, as the case may be. No, it's a fascinating, it's a fascinating thing. You touched on fundraising as a part of that, and the investors you bring in and all that. I think the company's been started and kind of existed up until the last couple of months in one of the all-time boom markets that have existed. I think you have uniquely had a level of pursuit from both because of your success, because of this sense of inevitability, because I think the pursuit of Ramp from an investor standpoint, I know me personally, is it's unparalleled from that vantage point. But maybe you've also been thoughtful about the round construction and who to bring in and how to actually make that work. Can you talk a little bit about that and like how you thought through your investor base besides, people with great podcasts and all that stuff, but what were some of the other criteria?
So I think a lot of it, so now I think just with the growth of the venture industry and also the angel community, it comes back to just like the first, I think even half a year of the company, where before, we did our first transaction within 50 days. I think we brought on our first customer before 5 months, 6 months, something like that. But even before all of that, we were talking to lots of different finance teams, angels, different people. And we said, here's our idea. We want to have a card that's designed to help people spend less. Super curious to get your insight, take feedback. And we kind of like try to change the dynamic around I'm not like, I'm going to sell something. What do you think? Would you buy this? To, we're trying to solve this problem. How would you approach this? And suddenly people were on the same side of the table. And that led to, and I think our first round was something like, almost 50 different angels, some larger institutions came in, and we kind of had this feeling of co-building together. And this idea was, okay, well, they're a part of it. They want to have a small piece. And we try to have a more collaborative approach in how we sort of sourced our ideas. It turned out it led to lots of people who are willing and wanted to become customers, wanted to invest and wanted to talk about it. As we started going out into later rounds and wanted to fundraise, we tried to keep that approach. We would, in the same way, it wasn't transactional. It wasn't like, I have to do this round, let me pitch everybody down Sand Hill Road and see what happens, where to get the highest price. We tried to, go collaboratively, and we would have, we'd get interest and we would bring the price down, sell less. And so in a way, it allowed for employees, for future people who joined, and for the company to preserve more ownership, but also for investors to be a part of it. And when you think about, what are the I'm curious how you felt about it too, but like, what are the needs of like the GP or different partners on the other side? You could say actually it was really tough to get into a deal, and the price was very attractive. Could you make sure there was a win involved for everyone on the way through? And then because of the multiple round part of it, because we did smaller parts of the company that we're selling, we could do more rounds and kind of price more efficiently. But more than that, as we built real relationships, and I think the turning point and where we started working really closely together was, at first it started with I think a certain small check, and then we started digging into new verticals, and you helped us figure out and crack bill payments, which is an extraordinarily fast growing part of the business. And the reason that we're working well together is, a lot of people said, how can I be helpful? The difference is you actually came back with like really informed research and like time put it together with people who joined the company and changed the trajectory. And at the next round, we could say like, we want you to be a really large part of the round. And in some ways, like it's trying to be more efficient. I know at times it probably was uniquely frustrating because it sort of broke the norm.
That's one way of putting it.
Yeah.
No, I will say, in honesty though, I think it was amazing, and it's different people have talked about investing in having a bunch of investors to crowd out competitors and all that, right? Which I don't know. I don't think that was your intent. I mean, maybe that was a nice byproduct. It didn't feel like that was your intent. I think what you all did or were able to do. I don't know if I would give advice to try to replicate it necessarily, in that the product market fit you had, the repeat founder element of it, the speed at which you were growing, the venture market that was when you guys were running. Like, I'm not sure. It'll be interesting to see. I'm not sure it's totally replicable, but it worked actually perfectly well, where you kept everyone, it felt like, wanting more and wanting to add more value and wanting to help and feeling like they got a good deal just because they got involved at all, right? And so let me go earn an even better deal this next go round. And so it's fascinating. I don't know if I would give it as advice to people going forward, but it worked really well, I think.
Yeah.
And so on the valuation point, I mean, that's another one that you guys have never taken the highest price, if I remember correctly. And so how do you think about, I mean, valuations to some extent in the private markets, you could say it's arbitrary in that it's an agreement between one investor and often, I mean, in your guys' case more, but and a founder, right? For what the price of the preferred is worth. Now, there's a bunch of implications that go into that, right? The 409A is based on it, and how options are going to get issued, and whether that GP is going to keep their job or not. Right? There's a bunch of things that go into it, but I'm okay, thank you. But how did you think about that over time in raising these rounds? And then we'll talk about the most recent round. But let's start with the first one of how do you even philosophically think about valuations?
It's a super so first I think a lot of the way that people think about rounds, the first time you go through it is, I'm going to sell a part of the company that I'm never going to get back, and so I better get the highest price for as little dilution as possible. And that is the way I think 90% plus of people will fundraise. And it ties to all the old advice too about fundraising. It's go see everybody, run a process, do it in under a month, don't say more than you need to, and just see what happens and run this auction. And I think that makes sense if you're a selling thing once and that's it. But people forget, when you sell part of your company, you're tied together for years.
Yeah, the joke I'll make is if you're selling your house, who gives a shit? If that person's moving into your Airbnb over there and staying with you for the next 4 years, you want to check. You want to make sure their hygiene and all that, right? And I think it's true if you're it's actually one of the few relationships you can't legally unwind, right?
Yeah. It's not up to me. It's a part of the company has been sold, and beyond it, there's real fiduciary obligations to do what's in the best interest of all shareholders the way through. And so actually I think the right optimization is what is going to maximize the total enterprise value of the company over time, or keep it simpler, create a sense of inevitability to help you achieve, to help you recruit incredible people, to have excitement, for the next round, people who feel like they want to buy more of the company, enough capitalization to be there, to even all the other attributes. You had kind of hinted at it, but 409A is a real consideration where in some ways, if you don't push the price up all the way, one, maybe you don't sell as much, and you retain a higher percentage of the company. But the other subtlety is on the valuation that employees are able to buy the stock. It is dictated functionally by where was the last round priced. And if you don't push it, it actually is a benefit to employees, which at the start we talked about is probably the most important thing in building a great company. And so we sort of just arrived as if you kind of ran through the logic to its conclusion. We felt the right way was form real partnerships with people. Have more distributed ownership, in part because you can see who is adding a lot of value, keeping the portion smaller and at lower prices, which benefit employees, which allows you to be more efficient with price finding at any given time. And then last, even the simple stuff of I hate to see people talking about what's going well in their portfolio. And It turns out when you have a lot of people saying this is working well, people hear about it. People are willing to help. And, you can't always predict. Not everyone is equally helpful. I'm not just saying this to make you blush as you've been, but it's, I think if you can pull it off, especially for a very long multi-year business that's moving, I think it's a great model.
Yeah, no, it makes a lot of sense. And that's one of the things. I mean, it's obviously self-serving for me to say just don't optimize price. Find what fair market is. I don't think that I or VCs deserve a super discount, right? But feel out what the fair price is for this, and then go from there and pick the best partner.
Well, even too, on moments I don't know, it's we're filming this. It's June of 2022. There are a lot of tech stocks that are from November down 70%. If you have kind of the most outliers, could be 90. And the reality is at any point of the market, it's a long walk. There's some things that are up and down. And if you're trying to juice and take every dollar and every maximum, it might help over the short run, and you might have more in your coffers at any one period of time. But if you're thinking over the course of 10 years or longer, the investor can be with you every step of the way. And so are you ever just setting yourself up, your employees up for a bad time? I think that you are if you push it to the extreme all the time. And so again, it goes back to all right, a lot of this is keeping people aligned for the very long run, viewing it as you have stakeholders in a real partnership across every step of the way. I think is better. I think it's a better model.
I mean, I agree, but it's also self-serving for me to say that. Yeah. So now, last round was announced in March.
That's right. Yeah.
And happened before that, obviously. And you alluded to tech stocks. Are not doing quite as well, at least as they were in March and before that. So I guess I'll give you an opportunity for a commercial here. What do you say to an executive that that is saying, hey, whatever, you did this round and now the market's down XYZ percent, right? And to some extent, it goes back to like the arbitrariness of valuations. But what is that message that you'll say to a sophisticated executive, a sophisticated engineer who's trying to understand the valuation and justify like why I should get on this rocket ship now?
Yeah, first, just to give like the ramp pitch, and then I'll give like the forget what the company does. Let's just look at its size and sort of think about it. I think first on the ramp side of this, like our core value proposition is to help companies spend less money and spend less time. It's viewing a dollar as valuable. And in a world where the cost of a dollar has gone up dramatically, the importance of making sure that you're getting a high return on it, it's never been more important. And so in many ways, like it's been a huge opportunity for Ramp. We have to be there for customers and increasingly deliver more and more value. But it's led to some of our fastest growing months, I think, since we've started during this period, because suddenly like saving is not a nice to have, it's important. So over the long run, that should help. That I think, probably safe to say, lounges are nice. A glass of wine every 6 months in a lounge is a great thing. But cutting costs now when it's important and people have that scrutiny matters. But let's say it's not just Ramp. Let's say it's any kind of company.
Yeah. Let's say company valued at $8 billion. And what's your how do you explain that point?
Yeah. So let's take like sort of two companies. You don't know anything about the companies. One company's, let's say in November 2020, $8 billion. Let's say another company, it's at $100 billion. 2022. Or 2021. 2021. Let's say that both are in the same sector. They're trading at the same, let's say if you want to take a revenue multiple or something like that. The public company, let's say it's at, goes down to 25. Let's say you don't have a view on the company at all. You don't know anything about the cash flow behavior. It's totally opaque, and we can talk about more of that. But you say, oh, all right, well, it should move at least in line with it. 2, fine. All right. You want to take that. Now, company A, let's say, is growing at 50% per year. Now, if you're going to go and do 50% per year, maybe it's going to take 5-6 years if things totally go right. They maintain that growth rate to get back to 100. Company B, let's say, is growing 400% per year. And so the question is, one, assume that they both are equally in the same situation. Which one do you want to be at? And if the second, by the way, is not just growing faster, but has strong cash flow characteristics, is burning very little, has a large cash bank, which one do you think is going to be easier to, one, grow into it, and then later, two, by the way, grow faster? I'd argue just simply mathematically, you don't need to know anything about either company. There's a lot of advantage to the second. Beyond that, when you take a company that has almost all the capital it's ever raised, is uniquely well suited, has extraordinary product market fit, and by the way, has grown. Well, that could be the exact figures fairly dramatically. Since what I'd say is, look, I people need to pick what feels right, for them, and be the right fit, not just in compensation, but in career. But I think there's actually really a unique selling point to one that's going after a very large industry.
Yeah, no, and I guess the two things that you didn't hit that I think are also, maybe self-evident, but we talked about it earlier. You haven't taken the highest price along the way, right? It's not just one person that agreed to this price. It's a lot of fairly smart, take me out of the equation, but otherwise fairly smart people that agreed to invest at that price as well. And so presumably there's buffer on what the high watermark could have been, right? Also, the growth rate is far beyond, right, what anything else is. And then for employees, there usually is a buffer with the 409A as well, right? And so there should be really good upside. Now, sometimes that buffer doesn't always work out, but I feel pretty comfortable with you guys. Yeah, no, that all makes sense. So shifting gears out of the valuation discussion. So between Paribus and Ramp, you've had a lot of investors court you along the way. Any crazy stories of like what an investor has done that to try to get onto the cap table?
I think probably like one of the more interesting, more memorable ones is if you go way back into Twitter history, and if you're a large could be any size Shaq fan, and you look at his tweet history, you'll find that he tweeted about Paribus. And if you look at it, it'll say, Kazam, Paribus just saved me $200 on this hot tub. It'll grant you one wish. Thanks, Paribus, for helping me save this money. Glad I did. Check it out. Paribus.com. I totally butchered the tweet, but the idea is like Shaq out of nowhere after years of, I think, not talking about Kazam publicly for like multiple decades, like was tweeting about some reference to like this product that had, I think, like 5,000 users at the time, maybe. And it totally blew our minds. Like, how did that happen? Well, there was an investor, I won't say which one, who said like, look, like we can show you, we know lots of celebrities, we have a lot of influence, and like we can get people to talk. And I'm like, dude, I don't know what you're talking about. We have like, we're working out of like an apartment. We have a small number of users. And he's like, who would you want? Are there any celebrities, basketball players that you know? Like, I'm close with Shaq. I'm like, well, if you get Shaq to tweet like Kazam, like, like, could you do it? And so he's like, yeah, I'll get it done. Didn't believe him. A few days later, he's like, I'm with Shaq. He's going to tweet it tonight. What do you want it to say? And I'm like, are you serious? Like, dude, I'm totally serious. Like, send this to me. You've only got 2 hours. He's going to do this. So we put this together, get together with my friend Zach, and we were like coming up with like, what would Shaq say? We didn't really watch basketball, but we knew a lot about Kazam and video games and bagel bites and that kind of thing from our childhood. And so we were like, we knew about that. We were trying to figure out then what would Shaq buy, and so we agreed, well, maybe he'd be in like a hot tub somewhere. And so all that, we put that he bought a hot tub for $1,400, and it turns out in retrospect Shaq would probably buy a much nicer hot tub.
Yeah, I was gonna say,
not sure that he would fit in it, or that anyone could get a hot tub for that price. And that we'd had him save like $200 on the thing, but he posted it blew up. Everyone at YC is like, what is going on? You've got like celebrities from a decade ago talking about you. And so that was very memorable. I think maybe it added like 10 users, but
is that right?
Yeah.
Oh, it didn't actually do anything.
No, it didn't even work, but we loved it.
Yeah, that's so good.
Yeah.
Did that person get on the cap table?
Yes.
Good.
Yes.
Yeah.
I still work with them. I won't say.
Good.
They're great.
We'll talk offline. Yeah. All right. So I don't know if you know this, but you deserve either credit or blame, depending on what people think, for this being a thing. We were sitting at right after I hired Josh, whose nice apartment we're at right now. He's a partner at Redpoint. I had hired him from NASDAQ to come over, and part of my vision was the ability for us to do more. We were in a pretty competitive environment, right? This was, I guess, December or November of last year, trying to find ways to stand out and cut through the noise and kind of create the sense of inevitability, as you talk about, right? And so we were at Jeffrey's Grocery in the West Village getting drinks, and me and Josh, and we were sort of mapping out like the different types of things that we could do to try to stand out. And I think I probably have notes from it, like talking you through, hey, I think I'll do this podcast, and I don't know exactly what form it'll take. So depending on whether or not people think this is good, you either deserve credit or blame from it. But one of the interesting things, I guess, you have a very interesting perspective and thoughtfulness around the media, around content, around branding, and all of that. I think you're very purposeful with Ramp's brand. I've learned a lot from you about like how to think through dissemination of information, the ability to create that sense of inevitability or coolness or whatever that is. Can you talk a little bit about how you think about that as it relates to Ramp or brands in general? How do you think about the relationship that exists between companies, between branding, between media, how all those things kind of fit together?
Definitely. So some of this kind of came back from the Paribus days when we really we established we had no money, we did have mustaches, but we our way of acquiring customers for the savings app was quite limited. Maybe we could get referral to work that didn't cost a lot of money and could help us get to the millions of users that we would need in order to have a workable business. Couldn't really buy ads, but we said, well, we're helping people save money. I used to watch local news as a kid. It was on in Las Vegas, and I was wondering, well, how could we get how could we be on Good Morning America one day? How could we be on a local pitch? And it turned out Good Morning America did not want to hear from me.
Yeah.
If they were telling news, it needed to be national news. They weren't going to take a pitch. CNN was not going to go and answer an email on it. And the question was like, well, is there anyone who would? And we learned a lot from other founders, but also just in noticing there's some great books on this too. One of which, tough title, probably doesn't make me look wonderful, but is a book called Trust Me, I'm Lying by Ryan Holiday, which his job was basically how could you blow up, like it was like Tucker Max and I think American Apparel, and a lot of what that philosophy was around is it was really around this question of how could you do things that were interesting and figuring out who was actually receptive to different pitches, different levels. And
it's an amazing book. After we talked about it at Jeffrey's Grocery, I went and read it, and it's fascinating. I mean, the type of stuff he does is definitely on the line of ethics. I think that we could talk about. One of the examples was he went and Tucker Max was coming to a city, and he went and graffitied the billboard himself, even though he was the PR person for Tucker Max, and then took a picture of it and said, people are so mad about this, let's send it to the local news. And so he did some stuff that was a little more ethically dubious. Good podcaster now, it seems like. But yes, it's a fascinating book about the relationship between media and brands and all that stuff.
But I think the thing that was incredible about it, and the big insight, which in some ways sounds obvious when you say it, but is so different in the way people will approach telling stories, is in storytelling, it is not about like the marketing message that you have and your message and how do you get it out there. And I think a lot of people are like, I need more people to hear about me. I need comms. I need to go and send this stuff out. The question is, what is actually interesting to people? Ryan maybe was more manipulative, but like the question is like who is this message actually appealing for? How could you craft that, pull that together? And so a lot of this is really trying to think through what's interesting on the other side of it. And then if you have that, can you create momentum on it? Were like the two critical insights. And so it turned out that the local reporter in Las Vegas on that ABC 13 was not getting pitched very often, even though there was someone on staff which was like Consumer 5 on Consumer on Your Side or Stretch Your Dollar or different segments that were on real tactical ways that people could save more money that week. It was also true not just of Las Vegas, but of local affiliates in Tampa, in Topeka, Kansas, in New York, and all these places. And if you could actually think about who's actually there, what's the producer, we might have had a couple users in all these different states. Maybe people were saving money. Could we have a unique way to reach out to someone who actually was interested in that story? And we started doing this. We'd reach out to people and email people in Las Vegas and in LA, in New York, and before you knew it, there was coverage that was starting to pop up all across the country. And then later we could go, to national news and actually say ABC, Good Morning America. Like we've been on 10 ABC affiliates with these segments. It's great. These are real people saving. We'd love to take this as larger thing, and you establish the real credibility. It came through, and you could kind of move through the ecosystem. And I guess there's going to be different things that resonate with different markets, but I think just being, receptive of one. At this point, if you're still with us in the podcast, it's like been over an hour. Like if most people have tuned out because maybe this isn't interesting, but hopefully we did a good enough job of actually being interesting enough to stay on. And I think that's true of most media. If you can actually think through of like what is a message that either is worth listening into, or will be interesting to someone who is covering a certain beat, and you can, effectively be a good partner, have something real in it. And so I think a lot of it comes down to, one, don't just like pitch people blindly, like actually be thoughtful of like who's on the other end. And two, like if you can do that, have things that are actually interesting, that can be not just a thing to be managed, but a great way where you can reach a lot more people, tell interesting stories, get more into the background, the ideas, the philosophy, the mystique, the bizarre Shaq stories. And I don't know, it's build a different kind of audience. No,
it's been super helpful. It's been super helpful to me. And I've been purposeful about like when to have you on, just because I wanted to make sure I was, I didn't want to do you first because I knew our conversation would be different. And I wanted to learn a little bit of stylistically, but each person I have on gives a little bit more credibility to the next person that's going to come on, right? And sort of creating that sense of like, all right, well, if this person did it and that person did it, then Maybe okay, so that's good. Those are all real people. Like I like that, right? But we talked about like even the part of we kind of have our newsish section and commentary, and then I bundle it with the interview, and people are like, "Oh, I just want the interview," or "I just want the news," and I'm like, you know what? You're getting both because some people come just for the interview, some people come just for the news. But if you can keep them together, like I think ultimately people come for they might come for the interview, the person that's going to be on, but stay for the connectivity between the two or the personalities that are on and all that stuff. And so it's it's interesting. I mean, I give you a lot of credit both from like how Ramp's been built as well as like at a very product level. You guys have these modular elements, right? But you integrate them together in a really nice way. But then also the branding and purposefulness and the inevitability of all that stuff. And so thanks for doing this. All that stuff is something that I've really internalized, and not that this little podcast is a business itself, but I think there's a lot of lessons that you guys have executed on that I've certainly internalized. So
we feel super lucky to be able to work with you, and this has been a ton of fun. It's been fun seeing the podcast blow up too.
Yeah. Well, good. Well, thanks for doing this, Eric.
Well, thank you.